Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over the Q1 GDP results for the United States. Now, in a shocking twist, real GDP actually contracted, and it contracted on an annualized basis by 1.4%. Now, the trend that I'm showing here is actually negative 2.5%, and the difference between mine and the BLS statistics is because I'm using the consumer price index to deflate the GDP into its real numbers, while the Bureau of Labor Statistics uses the GDP deflator based off of personal consumption expenditures. What's the difference? Well, real GDP claims to adjust prices for what consumers are actually spending on, whereas the consumer price index is a fixed basket of goods. In other words, consumers may change what they're spending on based off of prices. And that's one of the reasons why I use the CPI, is because the CPI more accurately captures what the price level is in the aggregate economy, and it accounts for the changes in consumer behavior, while the Bureau of Labor Statistics does not. The Bureau of Labor Statistics basically just goes with whatever the consumer spends on and takes no account into why the consumer changed their spending preferences. So if the price of beef is high and consumers switch to pork, the real GDP calculation captures the consumer spending on pork, but mine captures more of a historical precedent of beef and pork mixture together. So there's just a difference in statistics there, but I like the way I use it. It's a more conservative estimate of gross domestic product. Why did this happen, though? Well, I had been warning about this for the past several months. I produced a video on October 4th, and I'll put that into the link so that you can see it for yourself. And I also posted a video, one of my earlier ones, on July 31st. I'll post that one too. And I was warning that, of a trend that I was seeing in the gross output, a broader measure of GDP. So gross output, just to recap, is a measure of GDP plus what we produce to get to that final GDP number. So it takes into account construction, manufacturing, mining, all of those stages of production in addition to the final stage, which is what GDP is supposed to represent. And I noticed that when you adjust for producer prices on the producer side of the economy, we were already in a recession here on the producer side. So even though orders and demand is through the roof for getting goods out the door, the problem is there's been supply constraints and really high prices that's delaying these projects from being finished. And because of that, it's the volume of goods produced on the manufacturing side has been declining. Well, I pointed out that if that's happening upstream, it's only a matter of time before that hits downstream and hits the real GDP number. And just to proof in the pudding, we go back to the 2008 recession. We can see how first we see this huge drop in the producer side of the economy measured here in red. The real GDP is in green, and the blue is the real gross output together. And although the two tended to correlate together, you can see how while real GDP was growing, gross output was lagging here in 2007, and then in Q1 2008, it just plummeted. The bottom fell out, and it started dragging down. Well, we were noticing a similar thing here in Q1 of 2021. We were seeing a real gross output, caused by real high producer prices, was actually going into recession, less quantity goods produced, and that trend has continued, and I figured that it would just be a matter of time before it went to real GDP. But I wasn't quite sure that it was going to happen in Q1 of 2022. I was thinking it was going to happen later on in the latter half of the year with building price inflation. So where did I go wrong in my assumption here? Well, we need to take a look at the components of GDP. So there's basically four major components. There's your personal consumption expenditures. That's what private citizens are spending on in the economy. There's your business component, what businesses are investing and using capital expenditures to increase production. There's your government side. So the government tries to invest in the economy with infrastructure spending, and the government does consume certain goods. That needs to be taken into account. And then there's a final piece called net exports. We'll get into that one in just a second. Looking at the real personal consumption expenditures, we can see that since Q2 2021, adjusted for the consumer prices, real consumption has only slightly increased as consumers are feeling the hit on the prices of American goods being made. And so, yeah, there's a slight increase here, but it's been lagging ever since Q2. We're not seeing any of the normalized higher growths of consumption that's brought on from increases in wealth and income like we were seeing during the recovery of 2008. We're seeing more of a flat line here. Why? Higher consumer prices. Seeing a similar thing when it comes to business investment. Again, businesses investing in capital expenditures also being hit on higher consumer prices here. Government consumption and investment has actually dropped when adjusted for consumer prices. That's an interesting note, but the big one here is the fallout in net exports. So what's going on is that imports are increasing at astronomical rates and exports are not keeping up with it, okay? And when you adjust for consumer prices, your net exports are dropping. So we're importing more goods, exporting less goods adjusted for prices. Why? Because the prices of consumer goods are going up. When you have the prices of consumer goods going up, it charges a higher price to the customer. There's less foreigners demanding our goods relative to these prices, and we are importing more goods because they're relatively cheaper to what you can buy domestically. That's what's causing the contraction in GDP, and that's the part that I missed. I did not take into account that consumers could change their spending preferences, and instead of spending more on domestic goods, they'll start spending more on imported goods that are still relatively cheaper than our domestic goods, but that has to be discounted to the GDP numbers. That's why we're seeing in the contraction right quick. One last thing to note here is when we take a look at net investment. So when we take a look at gross private domestic investment, that's your business component of GDP, and subtracting out the consumption of fixed capital, it flatlined in Q1 2022, and that's not taking into account consumer prices. So no doubt we're seeing a dip in here, and we'll see a dip in net savings in the next quarter when those numbers come out in the next month or so. And that's certainly not a good sign for the economy, because without more investment into increasing production, you're not going to get the real growth, sustainable growth in GDP that we need that tells us their economy is healthy. You can see here that in Q1 2006, net investment peaked, and what we saw here was a decline from that point forward from 2007, 2008. That's an early warning indicator that your economy is faltering. Similarly, we saw problems starting to develop in Q2 2019 that may have signaled a slowdown in the economy as net investment started dropping. Also, when the economy almost tipped into recession from the shale oil boom and the consequent oil bust in domestic production here, caused by lower gas prices, we saw a drop in domestic investment. So the trend is pretty clear throughout. You'll see that domestic investment, net investment will drop first, then it will cause a drop in real GDP growth over time and possibly tip into recession if we see a sharp contraction. So looking forward, what does this mean here? Well, does this mean that we're going into a recession? Probably, because the forces are not going to change. It's going to be the same thing. We're going to be hit with higher consumer prices. The idea that consumer prices have peaked is for the birds. We're going to be hit with this, and more than likely, Americans will start spending more on cheaper foreign goods relative to American goods to try to bypass that, which will subtract from GDP. So I expect that the Q2 GDP numbers will be negative. Is this the end-all, be-all? Is this something that you should be heavily worried about? Well, from an investment standpoint, yes. If you're heavily invested in stocks, then yes, this should be something of grave concern to you. On the other hand, this might cause a flight to bonds, and so bond interest rates may not rise as much. But with the Fed's tightening monetary policy to contain rising price inflation, more than likely bond interest rates will go up. So those securities and the values of those securities will most likely drop in the coming quarters, as I've been warning here. Is this bullish for gold and silver? Yes, relatively speaking, because, again, the competitors to gold and silver, the two major competitors, stocks and bonds, they're failing right now. So it's just a matter of time before this is realized in people flying to safety and hoarding precious metals. Will this drop price inflation? Not really, because the real GDP is actually caused by price inflation. Now, you might notice that back in 2008, we did have consumer prices drop in 2008, but that was because of the bust of a credit bubble. The credit bubble hasn't burst here yet, okay? So we're not seeing a 2008-like scenario. What we are seeing is more akin to the recession of 1980 that was caused by building inflation. Now, if the Fed continues its hiking interest rates, which it most likely will, once it reaches a certain point, that will burst the credit bubble, and the real GDP contraction that we're seeing, which is a real diminishment of American incomes, that will feedback. That will feedback and accelerate the timing of the bust here for that credit bubble that we are seeing now. And we'll see a recession, a sharp, strong recession, much like what we saw in the latter half of 1981, 1982, and 2008. That's yet to come, and that's what you really should be worried about. This is just the opening salvo. Again, it's not something to be heavily concerned about, but if you are invested in stocks and bonds, this is very bearish for those two securities, and this should reinforce gold and silver. I'm not saying that gold and silver will shoot through the roof from this, but this should reinforce and provide some extra force to pushing up gold and silver over time. We'll see how that manifests. Again, you know, it's probably going to happen the latter half in the year, especially once the recession's confirmed in Q2. But yeah, this definitely happened. It caught everybody by surprise. If you had listened to me on my channel, you probably would have gotten at least an early warning in the latter half of 2021 that something was amiss with real GDP. But even I didn't foresee this, as Americans were just basically importing more goods. And guys, that's what I have for you today. Thank you for watching this video. If you like the content that I provide, make sure you just click that like button. Subscribe to my channel if you haven't already. Let me know what your thoughts are. Comment below. I appreciate the discussion that's been going on. And as always, click that notification bell. You'll be notified as soon as I do upload a new video. I'll post regular updates as I have been doing as the situation evolves. Once again, guys, I thank you for watching this video, and I'll talk to you next time.